I think our weighting has gone up in the healthcare sector because of rubber gloves. I mean, we held some, and they've done very well, and their weighting in the index and in our portfolio has naturally increased. It's interesting to say that people, things like Apple and Amazon and all of the FANG stocks in the US, there has been a PE ratio expansion there. Well, in fact, in the case of these rubber glove manufacturers, it's a PE ratio contraction. 2021 price earnings ratios of these glove manufacturers is between sort of 8 and 12 times. But of course, they have massive tailwinds at the moment, and their prices are going up, their volumes are going up, their costs are relatively stable. But I just want to point out that they're not that expensive, actually. If you look the next year or two, it all depends. And the share price performance seems to be relevant relative to the outlook for a vaccine. But also the electronics manufacturing sector is doing very well. A lot of the industries which have benefited from working from home in the US and in China, things like, internet, basically, internet-related and smartphone-related functions. The Malaysian electronics manufacturing sector based in Penang is supplying. So the earnings growth, that's where the growth is, I think, and that part of our portfolio has naturally risen as well. And we keep a good chunk of our portfolio invested in fairly visible, high-yielding stocks, whether they're real estate investment trusts, whether they're utilities. Banks we're less certain on now, but a few cash-rich companies with healthy turnover, even cigarette manufacturers. All these companies can give you a yield of 4% or so. Inflation here is -1 and a bit. So that's a real return of 5% if the share prices stay unchanged. You've got 2.7% for a 10-year Malaysian government securities. Looking a lot more attractive here than it might in other parts of the world.